XN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
You are listening to the Financial Survival Network. It's Kerry Lutz. We are here with Danielle Park. And while spring is breaking out across North America, hopefully it's not a false alarm, but certainly it appears that winter is breaking out across the world economy, regardless what side of the equator you're on. Very few countries seem to be exempt from it. Danielle, welcome. And hey, what is going on here? Looks like no matter how much money they put into the economy. I mean, look, daylight savings time was this weekend. QE1 started in the EU on Monday. 2 acts of complete futility, and looks like the world economy is finally becoming cognizant of that fact.
Yeah, a little truth is getting out, I think, Kerry, which is encouraging, frankly, because there's been so much of the sweep everything under the couch and hope for the best approach. Did you hear, incidentally, I don't know if this is true, but I was told yesterday, because I commented that the daylight savings seemed to come early this year, right? Have you noticed, like, it normally would come in April, and we had it in early, or at least the end of March, and we had it early March. And I was told that that was the change because they thought it would stimulate more consumers buying. If they have light earlier in the day, they would be out there wanting to go shopping more. And I thought, oh my God, now we're trying to literally change the calendar, the light, anything at all, because people are so desperate for sales. Anyway, what's going on, I think, is encouraging because a little truth is getting out, Kerry, and it's coming fast and furious. And it's, globalization was all the wonderkind on the way up, and globalization in the down cycles is equally awesome in its connectivity and the fact that there is great coupling all over the world of these economic patterns, and then that eventually financial markets also couple. And we've seen that in so many things to date, but things like the commodities, copper, lumber, oil, metals, everything has been coming back off since the peak in 11, as has bond yields have been falling again. Factory orders, now at the lowest since 2008 recession, all that good stuff. So it just really is confirming what we've been talking about for many months, which is that the global economy peaked in 2011, early 11, and has been slowing ever since. And that all these QEs have done is make this monstrosity out of some financial assets and do nothing for actual demand.
Yeah, it's really exactly what you're saying. Look, car sales, if you loan consumers enough money, I guess you could get car sales to go up to 20 million units a year, but it's not going to change the fact that they're taking out loans for, I guess, almost a decade for a car that theoretically could last a decade, but in all likelihood, probably going to be closer to 6-7 years. You have a clip on jugglingdynamite.com that I suggest anybody who hasn't had dinner or lunch should go watch it. There's actually these so-called investment professionals telling you to go out and take out a car loan, take the proceeds, and quote unquote invest the proceeds in the stock market. And I believe in leverage and certain types of investment, but to go take a car, an asset that you presumably are going to use for a period of time to get you to work or whatever, and take that, leverage it up to the hilt so you have no equity in it, and then go put it into the stock market. What are these guys thinking here, Danielle? I mean, these guys are nuts.
Yeah, stocks. Not just the stock market, but the stock market at an all-time high where the mean valuation on a whole bunch of metrics is higher than it was at the tech bubble peak in 2000. So, there may be some logic to be had for a low leverage loan to buy things in financial assets after they've collapsed to cyclical lows. But to do it at a cyclical high is truly suicidal. And the only time it makes sense, as we've discussed in the past, to sometimes borrow, to quote, invest, is when the cash flow that you're going to be collecting off the assets is likely to service the debt and then some. In other words, to pay back the money and have some capital growth. So that, for example, could happen if, dividend yields were high enough to compensate for the interest and the capital base was secure enough. So there's two problems there. The S&P today, for example, because it's at record valuations and terrible pricing, is yielding less than 3% today, about 2%, Kerry, which is where it was, by the way, in the top of the market in 2007 as well. So anyone borrowing today to try and buy stocks, you're going to implode your capital, and your cash flow isn't even going to be sufficient to pay back. In that clip, they were talking about a 3 or 4% car loan rate of interest. So it's just, what I thought of is how truly desperate the quote financial types have become, because we've just surpassed the 2006 car sales target. The amount of units that were sold in the peak of the subprime bubble in 2006, we managed to eclipse just recently in America, right? Well, the thing is, they did that by no money down and just financially suicidal terms, pumping cars into people who literally couldn't make the first payments. So then they started deferring payments for months, don't pay for 6 months and all that stuff. But what I think is really connected here is, you've got this corporate mentality, which is we want to grow sales and earnings every single year, regardless of what's going on with the middle class, regardless of whether people are getting any wage gains, because all our compensation is targeted to earnings growth and therefore stock markets going up. And what you're seeing is this realization that, the young people are not buying cars, Kerry, at the pace that they used to traditionally. I saw a couple of stats this week. So 40% of the cars in North America are today owned by baby boomers. Okay. And we know baby boomers are pushing headlong into their 60s now. Well, what happens? People drive less as they come to retirement, as they get older. They change cars less because, they get an Oldsmobile and throw it in the garage and it lasts them for a long time. 46% of the 17 to 35-year-olds today have cars. And that compares with nearly 60% in that cohort in 2000. So you can see that there's a bunch of reasons that young people are not buying cars. One, they're underemployed. Two, they're heavily indebted, as we've spoken before. They're also getting a little wiser and living more central downtown where they can walk places. And they're doing things like car sharing, which also makes a ton of sense.
Zipcar.
So I think those trends are going to continue. And I think the car industry is going to be back in serious straits here before long. And unfortunately, that means the debt bubble is coming to the next burst phase again.
And there's a couple of other things, Danielle, and I happen to fit into that baby boomer stage. Before I moved down here to Florida, I was driving 35,000 miles a year. Now I'm down to 15,000 and I can't figure out where the heck I go because I have no place to go to. Also, major demographic shift. People who are working, many of you work from your home. So you don't need to commute. All those see-through office high-rises all over the place. Office construction around the planet has ground to a halt because of the internet. And then the other thing is the internet has done this as well. Late model used cars, Carfax. Now you can find out if your car that you're looking at, a 90% chance, if it hasn't been registered with Carfax as having been in an accident, there's a 90% chance it hasn't been in an accident. And for instance, car that I bought, it was about a year and a half old, had 5,000 miles on it, still had the warranty, was in perfect condition, and I saved $12,000 off of what a new version of that vehicle would have cost me. So a lot of you out there are just buying these late model used cars and saying the heck with new cars. And then the other thing, Danielle, is this new category of buyer called the sub-prime buyer. And sub-prime, those are the ones that are defaulting now. You're seeing defaults go up, and it's like deja vu all over again, Danielle. It's just like Greenspan telling us and Bernanke, it's, oh no, this isn't going to have any effect on the market. The economy is strong. The fundamentals are strong. Don't worry about increase in defaults. Everything is fine. And for some reason, I just don't believe them.
Well, and it's really confirmed in all the data that we can see, and things like energy use, Kerry. You know, the gasoline miles driven has never recovered to the 2006 peak when the subprime bubble was fueling everyone's consumption of energy at record paces. That has not come back. So we see that weak demand in oil and gas is continued, and that's part of why we have such a bubble now in inventories and pricing and availability of oil and gas everywhere. Part of that is the production boom that came from the credit bubble, but the other part of that is that demand has weakened ever since. You know, as people get older, they stop driving their kids around all over the place. That's another thing. Those kids are moving out and living in group housing in downtown places because they have tons of student debt. So as you and I were mentioning before the call, notice that there was a talk out of the White House today about figuring out a way to get debt relief or bankruptcy inclusion on student debt. And I was saying to you that the big push for that is no doubt coming from the car lobbyists, because they're looking at their sales trajectory and saying, great, we've just eclipsed the prior peak of '06, but guess what? Population has grown since then, and we have, in effect, had negative sales growth when you adjust it for population. And also, as we look at these young people, how are they going to, we've already sold cars to people who shouldn't have them, who are going to just lose them in 6 months because they didn't ever have the income or ability to pay for them. We've downloaded all these cars onto the weakest links in the hopes that would keep the momentum going. We're running out of the weakest links, and we've got no strong candidates, or very few strong candidates in the young people who either have the appetite, interest, or cash flow to keep buying these cars. So what I love about this, Kerry, quite honestly, is we've been through this great financial charade where truth has been suppressed and magical mystery tour has been sold as recovery, and the financialization arm has just taken over and, rigged and jigged reality and trading and fabricated stuff. But what you're getting is that the real economy here, real humans consuming things, is starting to take the upper hand again. It's the same thing you were asking about the US dollar breakout. And yes, today it's now back, through 98.50, which is great. That means we're confirming our secular breakout trend that we've been talking about for the past 3 years. Next target on the US dollar index, which is that basket of world currencies, is 106 or 107 to 112 in that area. That is another trend that people say, well, that shouldn't be happening. Well, actually, it's happening not because anyone particularly wants it to happen, but because it is with all the mess they've created in the world, with all the debt bubbles, with all the weak currencies everywhere else, it's attracting capital back to the US dollar and the US bond market. We have the higher relative yields in North America. I've mentioned this before. If you look at the German yield curve right now, between 2 and 30-year bonds, Kerry, there's less than a 1% difference now. That yield curve has been flattening out. That's worse. That's lower than there was in 2008. So we're getting everything back to this idea that things are looking recessionary. We're getting levels registered in sales and inventories and bond yields flattening, and everyone's selling off emerging market currencies and coming back to the US dollar. This is all like a movie replaying from the financial crisis. And I think it makes sense because you know what? The financial crisis never did get fixed. Financial crisis was pining, perhaps asleep, hidden for some time below the surface, but it's still alive and well. And it's more ferocious now than it was then, because there's more debt in the world now than there was then, by trillions and trillions of dollars. So anyone who thought that was all nasty business behind us is in for a rude awakening here. And I think that it's heartening to see that, the financial policymakers cannot control all these moving parts. It's just too big for any one person to try and manipulate away.
And it's an ad for free markets. Let the free market fix things. You got to have the purge of the excesses of the boom time of the business cycle. If you don't, then you have what we have now, which is this kind of purgatory It's you're not in heaven, you're not in hell, you're just in this sea of misery, and the excesses continue on with no check and no reform of the system, and really, the way this has to end, it isn't going to be pretty.
The good news, though, again, I go back to this, that it's more encouraging to me because, what we needed was a cathartic event in the world in 2008. We needed weak players to fall on their own sword. We needed bankruptcies across the board. We needed a bunch of people to take their lumps and get fired and all that. That was the cleaning out mechanism that restores capitalism and brings back strength each economic cycle. Well, that was thwarted because they allowed all the weak players to receive bailouts and stay in the seat. Now, the good news today is that they're literally out of bullets. If you go through Bernanke's famous 2002 speech about, throwing money out of helicopters to avert deflation, he's really actually done. The central planners have tried every single tool in that list. Already done, Kerry, and we've still got the global economy contracting at a frightening pace for the central planners. So all that stuff's been done, and I see that as helpful because you're not going to get fiscal discipline put back in the system until you come to the end of that line of credit. So perhaps now you're going to have some looking back on how can we do fiscal measures. That may be the new chapter, but I think monetary measures are at the end of the road here, and that is a great relief for anyone who's been watching this maniacal stuff play out and just, basically horrified at how foolish and reckless these policies have been. They've created this mess, and now we need a cathartic event just as we did in 2008. And this time there won't be a quick fix. And I think that will be when we really get some cleaning out. And, financial institutions will have to take their hit this time. There isn't enough money in the universe left to even with a straight face advance to supposedly bail out these things.
Well, and here's the problem. So we need fiscal discipline, we need financial discipline, we need political discipline. There hasn't been any of that. We need some political maturity where somebody actually goes back and looks at history and comes up with solutions here. Because everybody's in it together. We've got to go back and all the promises that have been made that aren't going to be kept, right?
And I think you don't get, no one has will for that. Apparently, everyone's too terrified or let's say too spoiled perhaps by easy credit the past 15 years. But the good news is, as you're seeing in Greece, when the Germans are, balking on giving them more without any strong rules attached to it, you're seeing that, there's a breaking point that comes. And I think that you're at that breaking point in a whole bunch of places right now. So fiscal discipline may be not something that anybody actually chooses, but at the end of a credit line, it is forced on human behavior. And that is when we've always seen changes actually happen. That's where the individual changes. That's where the corporation will either go through a restructuring or become defunct and bought up by stronger players. And I think it's where governments will, finally hit the end of their nonsense because they just can't keep it up.
So, but the populace of the Western democracies are kind of convinced that basically corporations are totally responsible for this, and the government is just there trying to fix it. And the problem is, so many don't understand that the government was part and parcel responsible for this mess, and all the promises that have been made, the government debt, both in the U.S. and around the globe, at the state, local, and federal level, and just substitute your country's scheme, whether it's provincial debt or federal debt, like in Canada. In Germany, half the municipalities are bankrupt there. Every Western democracy has got the same problem of making too many promises to retirees. Let's face it, government work, for the most part, especially in the age of technology, is just another welfare program. You've got 5-10% of the government employees doing 90% of the work, and the rest of them are just along for the ride, just just stringing along time between coffee breaks here and then waiting for retirement. That's the way it is.
The common theme, in my view, is quite simple. The larger the organization gets, the more credit is available, the less discipline or hard decisions need to be made, and the less accountable individuals are. So just as in a family, if your kid keeps coming to you for more money and they know you have a line of credit, they will whine and stomp their feet and want you to use the line of credit. And if you don't have any fiscal discipline in you, or you're too weak or on the take yourself or whatever, you may just keep adding to the line. But when the line's pulled, that's the point where you say, look, kid, no more money. And I think that's what happens with corporations and governments. They've been all in this together, the policymakers. Look at Alan Greenspan. I don't know if you caught him recently. He's been on CNBC again of late. And he's talking about, well, obviously we're at overvaluations here. And obviously QE had a major impact on asset markets. And obviously it's not going to end well. This is the guy who's staring down, what is he? He's over 85 now, isn't he? He's staring down the legacy that he has left. He was the original actor, one of the key people who began this very destructive phase. Remember also that CNBC was just starting back when he came into his power and made him really this celebrity status. Do you remember they used to follow him around with his briefcase on his walk to work and all that stuff? And I think that his ego just really got overinflated because of all this exposure. It was this perfect confluence of all these, ego-driven things that magnified bad decision-making. And we have come to the full end of that now. So you've got pathetic business stations reporting pathetic concepts, selling it as, quote, insight and advice, when in fact it's the complete opposite. And you've got a consumer that slowly and one by one, various degrees of pain, waking up to this reality and shutting that junk off. And individuals like the young people, like we've just said, maybe you could argue that it's forced on them, whatever. The point is, they're making some different decisions today. They're saying, not going to buy a house if it's overvalued, not going to buy a car if I can share or take Uber once in a while, just not going to do this. And I think the penny's finally dropped. So that means that we're going to get some price discovery in things. And you're not going to have an ever-increasing sales scale in businesses. You're going to have rationalizing and downsizing, and in government as well. I see it as very simple. It's across all political spectrums and all divisions of the global economy. So, we're all kind of hitting that endpoint together.
Well, I think that's a great thing, and we're in it together. You're right. And while we're in it together, take a look at Danielle's site, jugglingdynamite.com, especially just take a look at that. Those financial gurus telling you to hock your car and invest in the market. That is a key telling point that you need to get out of the market. When they start telling you to, next thing they'll be telling you, Danielle, go pawn your Rolex. And, there's great opportunities in the market. It's time to get out. Go over to Financial Survival Network. Take a look at the site. We've got so many articles. It's just an avalanche of incredible articles you need to take a look at. Sign up for our newsletter. The webinars are coming. Danielle, we will talk to you in a couple of weeks. Be well.
Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.